Hi, everybody, and my name is Fran Green. If you don't already know me, the National Sales Manager here at More2life. Now, today we are going to be exploring affordability and how we are establishing a borrower's regular payment potential and looking at what they can do with that potential payment that they could potentially put towards their mortgage as well. Now, in today's session, we will be looking to talk about why affordability is so very, very important. What is the reasons why we do look at that today? We will look at also what the regulatory expectations are from our governing body in terms of this activity and income and affordability assessment. Now, there are some people that assessing income and affordability is new to. So we do have a session that's based around looking at the basics of assessing it, but also might be enlightening to some people who've been at it for a while, actually, just give you a different perspective and some extra thoughts around how that can be achieved. And also looking at what the council has to say in relation to its principles and its standards when coming to income and expenditure assessment. So without wasting any time, looking at why is this important, thinking about the benefits to the customer. Now, there are several of these in terms of making those payments, even if it's a small payment on a voluntary basis, which with more2life, that could be as little as £50, which sometimes can be unlimited in the year. But at least once a month, with some of them restricted to a maximum of 12 in the year. Now, we have different overpayment limits on our products. That's up to 10% or 12% on our standard maxi product. And that is of the initial advance. But the major benefit of making those payments, even if it's just a small amount, is that you are able then to control an element of the roll up. That means that you're protecting your asset and the equity in it for as long as possible, as much as you can. Now, that can be a major benefit for their estate, so for those people, their progeny, that they want to leave a legacy to, you're maximizing that by continuing to control that roll up with a payment. But also for those people that maybe not have anybody to want to leave it to. Sometimes I do get that feedback from advisors that, well, actually, my customers don't have anybody to leave it to, so they're just going to let it roll up. Well, actually, by protecting the equity in their asset, they are actually protecting their future borrowing capability as well. Because nobody has a crystal ball, nobody knows what the circumstances in the future are going to be, and they might find themselves at a time in future where they need to tap back into their equity to be able to, I don't know, satisfy a care in the needs home or other borrowing need. And if they have controlled their roll up of interest, they can maximize that opportunity for additional borrowing. And again, with these payment potentials, if you are going to make a contractual or a commitment to making a payment, as you get with the likes of the payment term lifetime mortgage, which is a contractual payment over a period of time, or, an interest reward type product, which is a commitment to making a payment over a period of time, then you can attract lower interest rates. And that lower interest rate will benefit both of the two above that we've talked about there, benefit of the additional asset and equity for their estate, and also they can look to address any potential future borrowing needs. Now, I just wanted to bring that to life in a couple of scenarios, and this gives you a real pictorial sense. Now, this was based on a capital choice product. Products have moved on, unfortunately, but it's still representative or demonstrative of the point that we're trying to make here. Now, this was a £350,000 product for a 74-year-old single life, as I said, on capital choice. Now, by making a modest payment of just £300 a month there for the entire term, you can see, as demonstrated over the 15-year period, that they're saving a circa of about £30,000. So it's not an insignificant saving for their estate and or for the benefit of the ability for future borrowing. Now, I am coming on to some scenarios which actually compare our Apex plan in a variety of different ways. Now, as you know, Apex is currently paused in the market, but we are sure to see it back soon. But again, for demonstrative purposes, this is an illustration of an Apex 900 as was versus an Apex 900 with a 75% serviced interest. And you can see there's actually quite a whopping saving there by somebody committing to paying the service of the interest of up to 75% 8% over that 15-year term, it actually avoids them here from potentially getting into negative equity, as demonstrated on an anticipated price hike in a modest increase in house price growth. And there you see this equates to about a £255,000 saving on interest for the benefit of themselves, their future borrowing, or a gain for their estate. And then looking at this is another alternative. Now, this is looking at somebody who has a high release requirement. So they may have opted for that Apex 900, but they do have an ability and a willingness to make a payment of £158. Now, this is a slightly different scenario because, as you know, our payment term lifetime mortgage carries a lower age bracket. So this is a 58-year-old single life on a £285,000 property. As I say, picking an Apex product where they don't have any contractual or commitment to make a payment, but they will make a voluntary payment of that £158 a month for the 15 years, versus them actually doing the same, committing to that payment over the period on a flexi payment term lifetime mortgage. And because the interest rate is so much lower, then they will see a benefit, a saving to their estate of nearly £100,000. So again, all of these are reasons why it's really important to assess affordability, identify how much a customer can actually spare to make a payment on their mortgage, because it can be a fantastic customer outcome for them in the end. Now, looking at the FCA expectations in this regard, we have had a number of payments or papers out, the Dear CEO letters from the regulator, and various CP documents as well that we can review. But essentially, what are the expectations? They do expect us to conduct affordability assessments, and that's as old as MCOB. That has never been any different. So an equity release, a lifetime mortgage, is still a mortgage. So the need to make an assessment for the affordability is a staple of our regulatory requirements. Now, the benefit of that, as we've talked about quite a bit, is the potential to reduce that financial impact of that roll-up. Now, they also want us to promote regular payments for all of the benefits that we've spoke about there. And that is also looking at, the fair treatment of vulnerable customers, because many lifetime mortgage customers are in that vulnerable circumstance. And a proper affordability assessment also ensures that they aren't placed in unsuitable or unaffordable products. Now, again, they do expect us to tailor our advice, and we have got our flexi choice interest reward product that will be coming out shortly that will take tailoring of advance to another level. But they do expect us to look at a customer and treat them all as individuals, not one size fits all. And there are compliance and regulations. Aligning advice with the FCA principles ensures that we meet those regulatory standards, especially, as I say, in the consumer duty voice of concerning fairness, responsible lending for us as well, and also avoiding that foreseeable harm. They do also expect us to monitor outcomes to make sure our recommendations of our products meets the customer's needs and circumstance. And we as a lender will be helping you with that with our consumer duty data and feedback. If we do have anybody that does drop off plan, we can have a look at why that might have been. And they do require us to act responsibly as well, not to recommend products, maybe to younger customers that are outside of the target market for the products, without a strong justification. Now, coming on to then making the assessment, and I will say this is easy as 1 minus 2 minus 3 in terms of when you're looking at one, we look at the income. So what do we include from an income? So we're sitting down with a customer, we're looking at the income we can use to support any payments they're going to make. We're looking at guaranteed income or alternatively sustainable regular income. So that could be sort of regular overtime or regular bonus that they get because they always work the fourth Saturday in every month or whatever and have done for a long period of time. We do also need to think about any known future negative changes, not positive ones. So if somebody says, I've got an investment that's going to pay out in 3 years' time, unfortunately, we can't play that into income from day one. But if somebody says, well, actually, I know I'm going to lose this income in 3 years' time for whatever reason, we do need to work on that net lower income. We do say don't include any income that's not guaranteed or regular and not sustainable, such as one-off bonuses, which aren't part of an employment contract, for example. We can't play in future income or anticipated income, so, for example, gifts or windfalls or an inheritance that we're expecting to receive. Now, when it comes to what somebody's needs, we need to take that into account. So once we've got the income in, we then need to know what do they need to spend. So, people have to feed their bellies, they need to feed their families, they need to keep the lights on. So what we say to include in terms of their needs are the essential living costs, contractual payments, things that they have to pay, like their car payments, or maybe they've got a personal loan that they're going to leave outstanding. Perhaps they're paying for their grandchildren or their children still to be going through school and have fees. Things like insurances for funeral plans, pension commitments, medication, if they've got a regular charge for medication, these are all payments that we cannot actually do without. And also habits, some people like a drink, some people smoke. That's advice I don't have. I gave up 10 years ago. But, for somebody, they have to smoke on a daily basis. That's something that they're not easily be able to give up and reduce their outgoings on. And also think about travel costs. We all need to get to A to B, and that comes at a cost. And again, we have to get to A to B for work, for example, to see our family or what have you. So these are things that we need to take off the income before we're looking at that net disposable. Things that we say don't include, things that can be put off, things that they can live without. Now, what we say from a want, so there's three different areas when it comes to what we look at from an income and affordability point of view. It's the income coming in, it's the things we have to pay for, and it's the things that we will want to have in our life, because without them, our life would be simply not worth living. So that's things like home entertainment, hairdressers. Does somebody meet their best friend once a week in the Costa Coffee? That again, their mental health would be deeply impacted if they weren't doing that. We should include budgets for things like celebrations, Christmas, birthdays, weddings, births, etc. And if somebody is making a regular saving for whatever reason, and it's important that they make those savings, then again, we should include that. What we don't include is things that we can question with them, things like making a donation to a charity. Is that something that they can actually stop? And therefore, something that we can have a rich conversation about them stopping. And if the answer is yes, then we can exclude them from their income and expenditure accordingly. I have an advisor, I will quote him, Mark, you'll know who you are if you ever watch this back, where he sat down with a customer once and the customer had a net disposable income of a minus figure, but they were paying £200 a month in charitable donations. Again, these are the things our expertise and guidance and help with the customers can really, get them into a much better position. And it's also addressing some of that vulnerability risk. Now, what I would say is bank statements are our friends. Please don't be put off by them. They can be a great way of making the job of assessing income affordability really easy because they are a source of truth. So a customer can often have a misunderstanding of what their income and expenditure is. I know I do regularly. I tell an old story where I sat down with my bank statements to review it because I was budgeting for a specific big life event and spotted that I'd been paying cat insurance for a cat that had been dead 10 years. It simply missed my attention to detail. So, it's definitely worth, because these bank statements give you a source of the truth. They also enable you to validate the net income. Again, a lot of customers may have an inflated or deflated idea of what is actually coming in. It does enable you also to triage the expenditure without a detailed conversation with the customer. So again, you can use the bank statements to actually get your income and affordability and then have a targeted conversation with the customer rather than an open one where you're back and forth with them, where they're trying to access their mind palace as to exactly what it is they spend on what and how often. It'll help you identify savings for them as well. How long ago was it they, checked on their insurance premiums for their buildings and contents, for example. It will also help you identify signs of vulnerability, which again, we know our regulator are keen to do, and we all want to do. Nobody wants to have any one of our customers that are actually exposed to anything such as, scams or frauds. And I've got a couple of advisors out there that have got some telling stories about they've picked up stuff from bank statements that has ended them up, with the customer in a police station because they have been a victim of a confidence fraud. And it also confirms if any payment commitment of any type is viable. So, instead of you having to take the second best guess of what the customer thinks they have got going on, you can actually identify that absolutely, accurately from that bank statement. Now, we'll give you a couple of top tips on bank statements, and I actually might do a session on reading bank statements as a fuller session in the future. If that's something that you think could be useful to you, then please reach out. And the more of you that reach out, the more of you that I will have in that sort of training. But basic verification checks is something that you can also do. Check the address matches the customer's address. Also think about how recent the bank statements are. If they were old, then it might not reflect a true reflection of, what their current activity is. Also look out for connected accounts. You often have people might have two or three different accounts that would sit where they transfer money in and out of. It's really good to have an understanding of what that is. Is it because they are saving for a special event that's important to them? And then also query any suspicious or large transactions. Anything over £1,000 really is actually what's shouted out in anti-terrorism and money laundering acts to be something that we should question. And that's whether it's coming in or coming out. Even if it seems quite obvious, please do just ask the question as to what that is, because it's likely that it's something that you might need to pick up or will be expected to pick up. Now, as I say, from the FCA's expectations in terms of affordability assessment, this is what they require us to do as lenders. There is an affordability directive within MCOB, within a responsible lending strategy, where we need to look at the committed expenditure, the essential actual costs, as well as the discretionary spend, as we talked about, that their quality of life will be deeply impacted by. And income, as I say, we will look at taking that in based on what is sustainable and regular, and then take the expenditure away from that. And that's what leaves you with that net disposable income. Now, as lenders, we also usually haircut a bit of that to make sure we're very comfy that the customer can actually afford that monthly payment. So as that's our process, it makes sense that you guys follow the same process, which is pretty much what we went through before. What's coming in that's regular, guaranteed, and sustainable? What's going out that they have to pay and that they would want to pay to still enjoy their later life? What's left? And that's the sum of money that we use to support any regular monthly mortgage payment. And when you think about the term of what that's going to be over, so when do we think, if at all, that that situation is going to change? And that's when we think about how long we make those commitments for. Now, coming on to finally, what does the council say? So the council does have a number of principles and thoughts around this. They have an overarching principle in there that says that members will act at all times to deliver good customer outcomes for their for their advice, for their clients. And that comes back to, actually, if they can make those payments, we encourage those payments to control their estate. They could potentially get a lower interest rate for that as well. And we're protecting their asset for either their estate or for their potential future borrower needs. So again, coming back to that consumer duty piece about, offsetting any foreseeable harm, that's like a really important piece there. They also have required customer outcomes in there. That customer outcome one, which is members will offer customers the products and services that suit their needs best and which offer fair value. So again, if you've got somebody who has got an ability and a willingness to make that payment and that can attract a lower rate, then that's the better fair value option for them. Now, there are three specific advisor rules around this that you will find on the council website. So 2.3 tells us the appropriate details of the customer's income and any essential and non-essential expenditure should be collected. 2.4 says the consideration should be given to that information alongside the customer's likely future position, for example, following retirement or any anticipated change. And all of these rules actually align to what we said in regulation. It aligns to what it is said in MCOB. So it's all the things that we should and will need to be doing. And 2.5, an advisor should satisfy themselves that any mandatory payments for a product are affordable to the customer. And when we talk about mandatory, we have two types there, don't we? We have PTLM, where there is a risk to the security of tenure if they can't make those payments. So it's really important that we make sure that affordability is robust. And as a lender, we double check on that anyway, because we do get those bank statements, we do get the evidence of income, and we do our own checks against the affordability rules, as is required of us, as I said earlier, as per the Affordability Directive. But especially on those interest reward type products where the lender's not doing that, and it's all on you guys, on your assessment of the sustainability of the affordability of those payments for the period that we're committing them to. So that's really important that you are really super, super sure that those payments are affordable before we put them into that appropriate plan. Now, there is more resources available to you to help you with affordability. We do have product microsites on our website that has, some further information about payments and how things work. We do also have an income and expenditure form. Now, I find this particularly helpful if you are certainly going to be inputting our payment term, lifetime mortgage details, because it follows our system. But it also does give you an idea of the types of categories of income and expenditure you should be collecting, and working out then what the necessary net disposable income is. And we will also be having a packaging guide webinar. So that will cover lots of different areas of, packaging, certainly in the PTLM, but it might be actually useful for you across these other interest reward products as well, as to how you get your file in a robust state, even if the lender doesn't need that level of detail from you directly. And we will continue to be here to help. If you have any questions about anything that we've talked about today, about any of the products, the comparisons, or further support on how you can maintain your regulatory and council adherence to their requirements whilst delivering those best outcomes for the customers as well, please reach out. We are here to help.